Hello and welcome to another one of our Macro Mondays. We had an interesting week as we close to the end of the year. The Dow Jones has actually fallen for the last 7 days straight, which is showing some dispersion between the index remaining relatively elevated and the NASDAQ 100 doing quite well as well, mixed in with some kind of give back from the initial enthusiasm from Donald Trump getting elected. The industrials had a massive run on the back of that result, and now it's kind of giving back some of those gains. Under the hood of the S&P, 8 out of the 11 sectors were in the red for this month. And then in terms of the S&P Shiller CAPE ratio, it is historically elevated. We have seen it this high before, but it's getting to those all-time high kind of levels, which just shows that the market is expensive right now. So when a lot of participants are excited and enthusiastic and optimistic about the markets, typically they will trade at a premium. And then, of course, conversely, when people are not so excited about equities, then they may sell off and that Shiller CAPE ratio may come down dramatically. So the premium that you pay in markets is often quite closely related to the optimism in the marketplace itself. So what I did is I used the assistant on eccuity to search up the different S&P ETF sectors or the different S&P sectors by ETFs. And I got them here and I clicked on the symbol list button, which is the little list icon next to the get summary. And I toggled over to the comparison tab just to confirm that a lot of the market is struggling right now. You've got technology, communications, and consumer discretionary has done really well. Consumer discretionary would have definitely been impacted by Tesla. And of course, technology's done well and communications has also done well. But the rest of the sectors struggling and often falling into that negative territory. What I found interesting here in this chart, this comparison chart, is between ARK, the Dow Jones, the S&P 500, the NASDAQ 100, which is the QQQ, and Bitcoin to USD. ARK and Bitcoin are leading the pack and relatively correlated. And then you see that the NASDAQ is posting reasonable returns. And then the S&P and the Dow Jones, interestingly, lagging a little bit and losing its momentum. This definitely shows that investors are looking to go up the risk curve in order to try and find returns coming into the end of the year. ARK is a barometer for risk taking and investing in companies that may not be profitable and are on the more speculative side, perhaps. In this case, Bitcoin has continued to remain strong and has broken through that $100,000 range. So given that Bitcoin has driven through that $100,000 range, that was a huge milestone for the asset. There have been so many positive catalysts towards Bitcoin over the last 2 years. I think the banking crisis where Silicon Valley Bank went under, I think that was a huge catalyst for Bitcoin, I think at least psychologically. And then as we continue to see individuals and market participants being extremely negative bonds, so fixed income and fiat currency, with that in mind, it does make quite a lot of sense why Bitcoin is getting a lot of love here. And then you've got a lot of excitement and exuberance around some of the aspects and potential deregulation and crypto bullishness by the US government, which is most likely impacting the price too. Nonetheless, I think it is also connected to a momentum risk trade where you can see that other risk assets like the QQQ, like many high growth equities and ARK have performed really well. And that correlation is pretty strong with Bitcoin as well. Market expectation has the Fed lowering rates this week. I don't think it's as simple as that. There is a possibility that they pause, although there is a higher probability that they pause in January. The bond market is not reacting well to the current market activity, so that will impact the Fed's decision. And there are some inflation data points that are not falling so fast, or in some cases ticking up a little bit, which is most likely going to make them think twice about continuing to cut rates, because monetary policy is quite loose right now, and the monetary system in general has got a lot of liquidity and is seemingly loose. And they don't want to lose the narrative of inflation is coming down. If that was to flip and there was to be an expectation of future inflation that persists, and there is already a sense of that, and you can see that in the bond market, but ultimately, if the broader market was to then have inflation expectations, that could be a bit of a negative catalyst for equities, at least in the short term. Talking of bonds, if you look at Treasury yields, they are rising amid some inflation concerns. So the bond market is basically saying, hey, we think that some of the stuff that's going on is inflationary. Asset prices are going to the moon. That is inherently inflationary. It's a part of the inflation measure. And then there are some other inflation data points that we're concerned about. But really, it's about policy and the fiscal deficit in the US. So with those two things in mind, the bond market is rejecting lower rates. And this is the largest increase in rates post a Fed cut in history. So typically when the Fed cuts, along the duration, along the yield curve, you do often see that rates are going to come in as the overnight rate drops. But in this case, long duration rates have actually risen, and that is because of fear of inflation. This is actually the largest increase in history, and it's because there's basically a lot of optimism, a lot of signs of strength, at least in the kind of some headline numbers, despite leading economic indicators being negative for well over 2 years. There is seemingly a resilient and exciting story about the US. However, this fiscal story and the fear of inflation has basically made the bond market say, no, we want higher rates, and it's showing. Tesla continues to rally strong. Trump getting in has definitely helped. You can see that from where Trump gets in on the chart, Tesla has almost gone vertical. That actually makes a lot of sense. There was a lot of concern around his issues he could have with another Democratic term because he went all in on the Trump trade. So there was a lot of speculation that there were going to be some legal issues for him if Trump didn't win. That isn't the case. Given there's a price disparity between some of the larger cap names like Nvidia and Apple, perhaps in this bull market there will be similar enthusiasm towards Tesla and the future of Tesla, and the price could increase, and maybe they could catch up to and surpass 2 trillion or try and catch up to that 3 trillion mark. Now, this is not necessarily driven by the fundamentals of the business today. It is, I guess, again, another sense that investors are looking to take a longer term view. So when multiples increase, price to sales, price to earnings expand, basically what that's telling you is, yes, there's a lot of optimism, but two, in a sense, as valuations expand, investors are saying we're willing to take a longer time horizon before we get a return on our investment. And that is very psychological. So the willingness to look out 10 years today may change, and investors may be only willing to look out 3 years tomorrow. So what you have to kind of consider when these valuations expand is, why are the valuations expanding, and how long are investors willing to wait to get a return? And the longer they're willing to wait to get a return, it's in a sense, is a longer duration that you're actually forecasting out into the future. And the further out a forecast goes, the less likely or the harder it is to predict the actual forecast and be accurate with reality. This is a consistent kind of piece that we're seeing in certain areas of the market where these tech companies and AI related companies in particular are seeing a lot of love again. And in general, investors are willing to basically take a longer time horizon with their investments, at least coming into the end of this year. We'll see what happens next year, as there's a lot of interesting aspects. And of course, we're going to start to see the proof in the pudding when it comes to Trump's election. We'll actually see how the market reacts, how the internals react to them trying to reform a lot of the government. Basically, post-inauguration, you're actually going to see what's happening. At the moment, we're in a, I guess, speculative in nature moment in history, as none of us really know what's going to happen once Trump gets in. And we don't actually know the results. We are just speculating on possible outcomes. And of course, there are a lot of people out there that hope that he does achieve what he has set out to do, because that's what the people voted for. And we'll keep a strong eye on that and I look forward to seeing what happens post-inauguration. As always, this podcast is just for entertainment and informational purposes only. None of the topics we talked about contain any sort of buy, sell, or hold recommendation on any investment or asset of any sort. So we hope you enjoyed the podcast, and we look forward to getting back to you shortly with a new episode.